Dubai offers zero capital gains tax and free repatriation, which could boost your after-tax returns 40 to 50% versus London, Mumbai, New York, and Hong Kong. Here's the complete international buyer's guide for 2026.
Welcome to Dubai Daily, your essential morning briefing on Dubai's real estate market. Brought to you by Parag Kundawal, founder and CEO of Consultaa, a Dubai-based real estate consulting and global capital advisory firm.
Today is Monday, January 13, 2026. Today's episode: International Buyer's Guide, Tax Optimization, Currency Strategy, Repatriation, and Cross-Border Considerations for 2026.
Let's start with the foundation of Dubai's appeal for international buyers, the zero tax framework.
Exactly, Lily. It's a powerful incentive. We're talking zero personal income tax on salaries, zero capital gains tax on property sales, and zero inheritance tax. There are also no annual property taxes on residential holdings and no wealth tax. It's an incredibly clear and stable system.
And for those wondering about VAT, it's just 5% and primarily applies to commercial units. Residential units, especially off-plan and new builds, are generally zero-rated. The 9% corporate tax only kicks in for profits over 375,000 dirhams, and even then, free zone qualifying income can be at 0%. This predictability is a huge draw for investors.
This tax advantage directly translates to superior returns. Let's compare Dubai to other global hubs. Dubai's average rental yield was 6.76% as of last month. Some areas like Jumeirah Village Circle are even hitting 7.82% or higher.
When you compare that to London's 3 to 4% yields, which are then subject to stamp duty and capital gains tax, the difference is stark. In Mumbai, you're looking at 2.5 to 3.5% yields with tax on rental income. New York has high property taxes, and Hong Kong has its own tax obligations.
The key takeaway is this: a 7% gross yield in Dubai means you keep the full 7%. That same property in London might net you only 4 to 4.5% after taxes. That's where the 40 to 50% advantage in after-tax returns comes from.
So how does an investor fully unlock these benefits? It often comes down to obtaining UAE tax residency, which opens up access to double taxation avoidance agreements.
That's right. The main pathway involves getting a golden visa and then having a physical presence in the UAE for at least 183 days in a 12-month period. Alternatively, 90 days can suffice if you also have a permanent home or conduct business here.
It's important to note that a golden visa grants you residency, but doesn't automatically make you a tax resident. To get that official tax residency certificate, or TRC, you need proof of accommodation like an Ajari or title deed, your Emirates ID, bank statements, and a movement report confirming your days of stay.
And the demand from international buyers is just remarkable. In the first 9 months of 2025, over 30,000 investors from more than 150 countries bought property here. Foreign investors now account for over 40% of total residential ownership.
India continues to lead the pack, making up about 22% of the foreign buyer pool, with investments projected to exceed 30 billion dirhams. The UK is next at around 17%, followed by China, Saudi Arabia, and Russia. It's a truly global market.
And these different nationalities have distinct preferences. Indian buyers often gravitate towards areas like JVC and Dubai South for high yields and family-friendly environments.
British buyers, on the other hand, tend to favour luxury waterfront properties in places like Palm Jumeirah and Dubai Marina, often for personal use as a second home. we're seeing European buyers expanding across prime zones, looking for stability and portfolio diversification away from volatile EU markets.
It's also crucial for buyers to understand their home country's tax rules. The UAE has double taxation avoidance agreements with many countries, including India and the UK, which prevent you from being taxed twice.
However, one key exception to note as of January 2026 is the United States. The UAE does not have a DTAA with the US, primarily because of the UAE's tax-free framework. This makes advanced planning with a qualified tax advisor absolutely essential for American investors.
Let's talk about something that underpins all of this: currency stability. The UAE dirham has been pegged to the US dollar at a fixed rate of 3.6725 since 1997. That's nearly 3 decades of stability.
And forecasts show no deviation from this peg through 2026 and into 2027. This peg mitigates volatility and fosters immense investor confidence. It makes the UAE an incredibly reliable destination for international capital.
For specific currency pairs, the outlook is also quite stable. For the Indian rupee, forecasts suggest a range of 23 to 24 rupees per dirham in 2026. For the euro, 1 dirham equals about 0.232 euro. These fluctuations are important for buyers to consider for timing their entry and exit.
Another major advantage is the freedom of capital repatriation. There are 0 restrictions on moving your money out of the UAE, whether it's proceeds from a sale or rental income. It's a transparent and secure framework for capital flow.
There are some new rules from 2025 to be aware of. Payments must now go directly to the owner on the title deed, and overseas sellers need a UAE bank account. But this actually streamlines the process and ensures full regulatory compliance, making repatriation even smoother.
Now, a question we get all the time. Should an investor buy property in their personal name or through a corporate structure?
For most investors, personal ownership is the way to go. It's simpler, has lower compliance costs, and makes getting a mortgage much easier. Plus, your rental income and capital gains are already tax-free, so there's no tax benefit to a corporation for passive income.
So, when does corporate ownership make sense? Really, only in specific situations. If your annual net rental income exceeds the 375,000 dirham corporate tax threshold, it might be worth considering. It's also beneficial for complex succession planning, asset protection, and for family offices or institutional investors.
But for the average international buyer, the simplicity and mortgage accessibility of personal ownership far outweigh the benefits of a corporate structure.
This brings us to estate planning, which is vital. To ensure your assets are distributed according to your wishes, you must register a will in the DIFC or ADGM. This overrides the default Sharia inheritance laws.
And there's a new rule, effective this year. If a foreigner passes away with no designated heirs, their financial assets in the UAE will be designated as a charitable endowment, or waqf. So, proper planning is more important than ever.
Let's look at the market outlook for 2026. The market is entering a phase of moderation and sustainable growth. We're forecasting overall price appreciation of 5 to 8%.
However, there's a key area of caution. The mid-market apartment segment faces a potential 10 to 15% correction due to an oversupply, with around 64,000 new units coming to market this year.
On the other hand, luxury villas and branded residences show continued resilience due to supply constraints. Properties linked to new infrastructure, like the Metro Blue Line corridor and the area around the new Dubai South Airport, are also poised for increased value.
So, let's distill all of this into some actionable intelligence for 2026. What are our top strategic recommendations?
First, leverage Q1 2026 for acquisitions. You can often find motivated sellers and potential discounts post-holidays. Second, focus on properties near major infrastructure for long-term value.
Third, consider a 30 to 40% allocation to luxury properties to hedge against that mid-market correction risk. Fourth, if you can, establish tax residency by spending 183 days here to unlock full DTAA benefits.
Fifth, stick with personal ownership unless you're a high-volume investor. Sixth, register that will in the DIFC or ADGM. Seventh, get pre-qualified for a mortgage now, as rates are favourable and expected to decline through the year.
And finally, keep a close eye on market correction indicators. Watch for properties staying on the market for over 45 days, declining transaction volumes, and aggressive developer incentives. Those are your signs of a softening market.
So, to summarise the key takeaways for international buyers in 2026.
First, Dubai's zero tax framework gives you 40 to 50% superior after-tax returns compared to other global hubs. Second, the AED-USD peg ensures currency stability. Third, you have complete freedom of capital repatriation.
Fourth, the Golden Visa and Tax Residency pathway optimizes your global tax position. Fifth, personal ownership is the simplest and most efficient structure for most. And sixth, the 2026 market offers strategic entry points, but be cautious of the oversupply in mid-market apartments.
That's today's Dubai Daily, covering the complete international buyer's guide for 2026 tax optimization and currency strategy.
For personalized international buyer strategy, tax optimization advisory, and cross-border investment planning, reach out to Parag Kundalwal at Consultaa.
You can contact Parag via phone and WhatsApp at +971 585 96 4631.
Email at parag@consultaaadexb.com. That's PARAG@consultaaadexb.com.
Visit the website at consultadxb.com. Again, that's consultaaadxb.com. And connect on LinkedIn under Parag Kundalwal.
Dubai Daily airs Monday to Friday at 7 a.m. Dubai time. Subscribe for your daily dose of Dubai real estate intelligence.